Again, switching gears here a little bit, talking about creating a retirement specific financial plan, which is again the specialty of Capital Squared. We refer to them as Fortress financial plans. That's one of the names I came up with just to kind of help people understand what it means. And in terms of the key issues that I would say most of our clients face, and I'm inclined to say this shouldn't be surprising to most of you. Of course, at this stage in your life, people tend to have lower risk tolerance, essentially. That's how it normally works. We have many clients who continue working in their late 60s, early 70s. They enjoy what they do. They certainly don't do it for money in many cases, but at the same time, if they lose a significant portion of their assets, it will be hard for them to replace it. They certainly want to be protected against market turbulence, and I would say that point is of particular importance given the new administration's objectives. At the same time, for many of our clients, and yes, we're talking about late 60s, early 70s, we usually run our projections at least to age 95. We actually start doing it to age 100. So protecting against the longevity risk is important too. To say it bluntly, we want to make sure that our clients do not run out of money in retirement, meaning they don't invest so conservatively that over time they run out of money. The other point, which, I understand this is subjective, but for many people, once they achieve a certain level of wealth, I'll use that word, any additional or marginal dollar may not make that such a big difference. Once you have a certain lifestyle, as long as you're able to preserve it, you don't necessarily need much more than that. And again, these are some of the key considerations of what we do. In terms of the objectives, again, the idea is to create multiple lines of defense. I don't know how many of you visited France and looked at the medieval castles. I always found them to be rather fascinating when you see like a castle in the middle of some kind of field, and the way it was set up so that sometimes a few hundred people were able to defend a large area against like thousands of invaders or barbarians. So just that concept kind of stuck in my head. This needs to be, of course, customized for each client. You cannot have a model portfolio. It's just not going to work that way. And of course, it needs to be tax efficient. So we need to accomplish all three goals. In terms of the background, I understand this is somewhat generic, but this describes, I would say, many of our clients. Let's say it's a single woman, limited income, no pension, average Social Security, recently retired, has above average life expectancy, which is again common for women. And let's say her projected expenses is $10,000 a month. So how would we approach this? The first line of defense would be to have enough in cash reserves to cover up to 12 months of expenses. At this point, money market accounts are good for that purpose. We're talking about 4% plus in risk-free income. And again, the goal here is to really provide for immediate cash needs. Second line of defense, which by the way, hopefully at least will partially address one of the questions that was submitted to us. We like to build bond ladders that consist of individual treasury bonds. We'll spend a bit more time here. The reason we like it is because with individual treasury bonds, we know exactly when the bond is going to mature. We know exactly how much we're paying for it, and we know exactly how much we're going to get when the bond matures. Mutual funds can be perfectly fine when the markets are doing okay. However, and this doesn't apply just to bond funds, but stock funds as well. Like if you go back to 2020, when the markets are down and a lot of shareholders are redeeming their shares, the fund essentially needs to sell the assets inside of the fund. So your performance results even inside of a conservative bond fund can be unpredictable. That was exactly our experience in March and April of 2020. Things recovered. So if you don't sell, you'll be fine. But if you actually need the money, individual treasury bonds are more secure from that perspective. At least at this point, we're talking about yields of 4.4, 4.5%. Keep in mind, again, they're particularly beneficial for Maryland residents because you don't pay any state income taxes. So if you compare a money market fund and a treasury fund or bond, you will do better with the treasury. The idea here, as I mentioned, is again to ensure no stocks need to be sold in times of market turbulence. Third line of defense, I would say perhaps the most important one, we like dividend paying stocks. At this point, you're looking at 3 to 4% on average, depending on how you want to put it together. And the objective we have, which we cannot accomplish every single time, but that's our target, is to cover, as much as 100% of our clients' expenses simply from income, meaning they would not need to touch the principal. Again, I want to make it clear, we don't have this set up for every single client we have because you need to have a rather sizable portfolio for this, but there are a lot of benefits. Again, you're not touching the principal. Dividends tend to be sticky, meaning that they're usually paid by more mature companies, and they have a history of increasing those dividends year after year. So you get that inflation protection built in. Fourth line of defense, we like to overweight domestic large cap stocks, at least at this point. I don't want to go into much detail here, but this probably specifically applies if you work like with a financial planner or advisor. There's this concept of diversification, which of course we fully subscribe to. You don't put all of your eggs in one basket. Now, at a certain point, I call it a portfolio diversification with a W. That's the term I actually came up with. And if you every so often you look at someone's allocation, they have dozens of different funds, 20, 30, 40 different funds, international holdings, small caps, and everything under the sun. The question is, why do you need all of those things? I can go into much more detail on that. I will not do that today. But the bottom line is, for many people in this category specifically, you can do rather well by dealing mostly with, again, domestic large cap stocks. There are a lot of choices there. Finally, and this is again client by client basis, the rest of the portfolio, of course, needs to be invested in growth-oriented stocks. The idea is to protect your portfolio against inflation, and perhaps eventually, one of the questions I do like to ask, or sometimes our clients bring that up, are you really investing for yourself, or is this for the next generation? So what's relatively, happens relatively frequently on our end, as our clients, progress in their retirement, we actually adjust their allocations to be more growth oriented. It may sound counterintuitive, but again, the risk, it's when you're early in your retirement, and as you transition and your portfolio continues to grow, there's usually lower risk. What's the outcome here? Of course, we want to make sure that our clients feel confident that their portfolio can endure prolonged market turbulence. Like over the past number of years, if I go back to 2020, it was certainly nice when the markets recovered in 2.5 months, but that's not how it usually works. It can take much longer for the markets to recover. Of course, we want to make sure that in terms of the actual impact, which is not so much the dollar amount of the portfolio, but the cash flow, there's no or limited impact on the lifestyle. And again, with specifically with the income-based approach or the Fortress financial plan, is the idea of sleeping well at night, knowing that your retirement is secure. Those are, again, our objectives here.